You're watching the market tick up and down. Anxiety building. Checking your phone every 5 minutes. Constantly second-guessing your trades. What if I told you there's a trader who made $100 billion while famously saying, "The stock market is a device for transferring money from the impatient to the patient." Today we explore how Warren Buffett's tortoise beats the hare approach can cure your trading anxiety. Forever. Before the billions. Before Berkshire Hathaway. Warren Buffett was just a kid delivering newspapers in Omaha. But he had one obsession: understanding value. While other traders chased hot tips, Buffett would sit in his office reading 500-page annual reports. His edge wasn't speed or complexity. It was depth. He didn't trade companies. He bought businesses he wanted to own forever. Buffett operates on one simple, almost deceptively simple rule. Only invest in what you understand. He didn't just say this, he built a fortress around it. He calls this your circle of competence. And here's the critical part. Your job isn't to expand the circle. Your job is to know its borders with absolute clarity. In the 1990s, during the dot-com bubble, everyone was getting rich on tech stocks. Buffett openly admitted he didn't understand. The pressure was immense. Shareholders begged him to join the frenzy. His response? He wrote in his annual letter, "We will not dance in an area where we have no idea what the steps are." Outside that circle? Total avoidance. Not skepticism, not hesitation, avoidance. So, what's inside his circle? For decades, the same few themes. A business with a durable competitive advantage, what he calls a moat. Simple products, predictable cash flows, and honest management. While 99% of traders are frantically jumping into crypto, AI stocks, and whatever Wall Street bets is pumping this week, Buffett stays in his lane. Insurance, banking, consumer goods you find in a grocery store. Boring? Maybe. But ask yourself this. In a world of constant change, what's more valuable? Chasing the new and unknown, or mastering the timeless and predictable? Profitable? $100 billion says yes. Rule 1. Never lose money. Now this sounds so obvious it's almost a joke, but for Buffett, it's a solemn mathematical commandment. He said there are only 2 rules in investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. He takes it so literally, he'd rather miss 100 good opportunities than take one bad risk. This isn't about avoiding loss. It's about the crushing power of compound interest working in reverse. A 50% loss requires a 100% gain just to get back to even. His practical tool for this is the margin of safety. He only buys when a stock is so profoundly cheap, trading far below his calculated intrinsic value, that it creates a buffer, a shock absorber. In his words, you build a bridge to carry 30,000 pounds, but you only drive 10,000-pound trucks across it. That extra capacity is your margin of safety. So even if your calculations are wrong, or the economy slows, you won't lose much. Rule 2. Be greedy when others are fearful. This is Buffett's most famous psychological play. It's not about blind optimism. It's about recognizing that the market is not a cold calculator. It's a voting machine in the short term, driven by fear and euphoria. The ultimate case study, 2008. The global financial system was seizing up. Credit markets froze. Headlines screamed collapse. The overwhelming emotion was pure fear. That's when Buffett wrote his iconic New York Times op-ed, "Buy American, I am." While others were selling in a panic to survive, he had prepared. He deployed $25 billion. He bought preferred shares in Goldman Sachs and General Electric with lucrative dividend terms. He wasn't catching a falling knife. He was buying a masterpiece at a fire sale price because the whole building was on fire and everyone was running out. The result? A $10 billion profit in just 5 years. The fear of others had created his opportunity. Rule 3. The 20-slot punch card. Buffett poses a mental exercise that changes everything. Imagine your investment career is represented by a single card with just 20 punch holes. Every single investment decision you ever make for your entire life punches one of those 20 slots. Suddenly you become unbelievably, painfully selective. You can't waste a punch on a hot tip from a friend. You can't punch the card because of FOMO on a Reddit pump. It forces a brutal quality filter. You must ask, is this idea so good it deserves one of my 20 precious lifetime slots? This isn't a limitation, it's a liberation. It frees you from the noise, the pressure to always be doing something. It moves you from a trader, constantly acting, to an investor, patiently waiting for the perfect pitch. No more impulsive trades, no more chasing, just 20 truly great, thoroughly researched decisions. In your entire career. Rule 4. It's not timing, it's time in. Forget everything you've heard about market timing. Buffett's greatest edge is his relationship with time itself. His favorite holding period? Forever. He doesn't buy stocks, he buys pieces of businesses. And when you buy a business you admire, why would you have a sell date in mind? Let's make it concrete. He bought Coca-Cola in 1988. He still holds it today, collecting over $700 million in dividends from it, every single year. He bought American Express during the salad oil scandal in 1963. He still holds it. While day traders and algorithms stress over minute-to-minute moves, glued to screens, Buffett's clock ticks in a different dimension: decades. This philosophy does two things. First, it turns the taxing short-term capital gains tax into the friendly long-term rate. Second, and more importantly, it aligns your incentives with the companies. You want them to build real, durable value over years, not just hit next quarter's earnings target. His wealth wasn't built by buying and selling. It was built by buying and holding, through recessions, bubbles, and crashes, while the power of compounding did the heavy lifting. So how do you use this ancient wisdom in 2026, when everything moves at meme stock speed and your phone buzzes with a new opportunity every minute? First, actively define your circle of competence. This is homework, not guesswork. Are you a software engineer? Then maybe SaaS companies are your circle. A pharmacist? Pharma and biotech. Start by listing industries where you already understand the product, the customer, and the business model. Second, literally apply the punch card mentality. Open a notepad. Write, "My 5 trades for 2026" at the top. That's it, just 5. This artificial scarcity will force a new level of research and conviction before you commit a single dollar. Third, create your too hard pile. Buffett has a physical folder with that label. When he looks at a blockchain protocol or a pre-revenue biotech firm, he doesn't force it. He says, "I don't get it," and files it away. You must do the same. Your too hard pile is not a mark of ignorance. It's a declaration of disciplined focus. The goal isn't to know everything. It's to know with ruthless clarity what you truly understand, and to act only within that space. Buffett's real genius wasn't stock picking. It was psychology engineering. While the world chases shiny objects, he engineered patience. While others panic, he programmed himself to see opportunity. In an economy addicted to speed, his algorithm runs on slowness. So this week, try just one thing. Pick one industry you genuinely understand. Research one single company as if you had to buy the entire business and run it. You might not become a billionaire overnight, but you will start thinking like one. Which legendary trader's psychology should we break down next? Comment below. If this calm, deep dive style resonates with you, subscribe. We're dissecting the minds behind the fortunes,